Now for our ETF spotlight, I'll take a look at consumer staples, down 6% this year, and specifically Proctor and Gamble, which reported earnings today. Here are some of the highlights. It was a beat on the bottom line. Sales came in a bit light, though, especially that organic number. Organic sales growth, 1%. Street was looking for 2%. We did see pockets of growth in places like beauty and healthcare and home, which helped offset the declines that P&G saw in grooming and baby care. On the plus side for P&G, the company did see volume growth and market share increases for a change and projected 2 to 3% organic sales growth for the full fiscal year. Though on the downside, guys, pricing power is a concern. Pricing fell 2%. The company says it is going to have to raise prices this year on Pampers in North America, on Puffs, Charmin, and Bounty products by 5% for those because of rising commodity costs. It's a tough time for consumer staples and especially for household products. This follows a very disappointing quarter for Kimberly-Clark, which lowered its forecast. Colgate saw 0.5% organic sales growth. You've got pricing power concerns at a time where commodity costs are rising in a competitive environment. Are they going to be able to pass those costs on to the consumer without suffering a sales decline? That's what all the questions were about on the conference call, that pricing issue.
Do investors have different degrees of doubt about whether, say, P&G can do this versus whether Coke can do this? Does it vary by product category?
Yes, I'm glad you brought that up. Beverages are doing a lot better than household products. There's a real divergence right now in the staples sector. And I would put food, packaged food, right in the middle there. Both PepsiCo and Coca-Cola reported pretty solid organic growth. They're not in the 1% range. They're in the 3 to 5% range. So they're doing better, and they seem more able to pass on those price increases to consumers. Everyone's feeling the effect of the stronger commodities cost. Everyone's feeling the stronger dollar. All of these companies sell abroad. And even for Procter and Gamble, the feeling is that they usually, as the category leader in some of these products, can do that. And that they're continuing to retool their business, focusing a lot on local, empowering, the certain businesses, which was one of the critiques of Nelson Peltz in his fight to get on the board, which he is now on the board. You saw that in a big improvement in China sales, for instance, which returned to growth this year versus last year. There's still a lot of work to be done on this front. And overall, it's a pretty tough environment for the entire group. We'll see what shares do. It was actually an upbeat conference call. Company talking about market share gains, talking about returning to growth in certain categories like grooming, even though men just aren't shaving that much, something that the CFO always mentions.
Laments.
Yeah, yes. I mean, that's part of the problem. The other problem is these online upstarts like Dollar Shave Club, which was bought by their competitor Unilever. And the shares did turn around on that upbeat note, but they're down more than 12.5% so far this year.
Yep, indeed. Hanging in there right around 80.62.